Starbucks shares are trending higher despite missing their first quarter earnings estimates. You can see it's about 1.85%. The coffee chain says its traffic grew for the first time in 2 years. To break this down, I'm joined by Peter Saleh, Managing Director and Analyst at BTIG. Peter, thanks very much for joining us.
Thanks for having me.
Starbucks, what's driving it? We're seeing the uptick. People are liking what they're seeing. What do they like the most, do you think?
Yeah, I think what investors like the most is the traffic gains. If you look at the traffic, it was up substantially this quarter. So clearly they beat on same-store sales, 4% globally, 4% in the U.S. That's about 200 basis points better than what we were expecting. But sequentially, traffic was 400 basis points better, and on a two-year stack basis, it was 600 basis points better. That's the hardest part of the turnaround, which is getting customers to come back into your stores. And so that problem looks like it was solved or somewhat solved, at least the first step of it solved. So we're getting customers back into the store. So that's what the investors are liking here. And that's what's driving the shares higher today.
All right. And now CEO Brian Niccolo, when he came in, the back to Starbucks strategy, is this the results of it? And what has he done that's making this work or appear to work?
Yeah, I think the foundation was really investing more in labor hours and more labor in the stores, taking complexity out of the menu, reducing the menu by 25 to 30%. And so the end result here is faster service times. They're under 4 minutes in both in-store and in the drive-thru as well. And so customers are seeing that and they're coming back more often. I think the next phase of the growth here is going to be menu innovation, both in the morning and in the afternoon. And they're pressing the accelerator a little bit more on the marketing side as well. So I think those are the foundations for this turnaround so far.
And how important is that speed for customers and keeping them coming back?
Yeah, I think it's very important, especially in the drive-thru and especially in the morning. Customers they don't want to wait. If there's a long line in the drive-thru and your service times are too slow, your drive-thru can back up. Customers can drive right by the store and not come in. So I think it's very important. We've seen it time and time again in the restaurant space where you increase throughput, you increase your service times, you move faster, and you're able to drive some accelerating traffic trends.
And they want to add, you said they wanted to add to the menu, but they've reduced the menu. Is there a danger of those two canceling each other out?
Yeah, I think they've reduced items that weren't selling from the menu, and they're going to focus on healthier trends, energy drinks, different food for the afternoon. So it gives them a chance to be more innovative by reducing some of the items that previously weren't selling. So I do think that's going to be the next phase of the growth for them.
And then going the other way, I was reading that $2 billion in cost cutting over, I think, the next 2 years. Where will they find that? And I mean, if they're bringing in more staff, that's the biggest expense. How do they work with those two things?
Yeah, well, we're going to hear a lot more about that tomorrow at their investor day, but they've outlined $2 billion of cost cuts that they're going to get over the next 2 to 3 years. My guess is that'll come from supply chain and some, efficiencies using technology within the stores. But I think a lot more yet to come on those cost reductions, tomorrow when we hear more from them at the investor day. So expect a lot more detail tomorrow night into Friday.
Okay, and then let's talk a little bit about China. They got out of it as owning all of it. They're working with Boyu now. How is that starting to come together for them?
Yeah, I mean, look, they sold a significant portion, a majority stake of that business. They're going to use that capital to pay down debt. They're still going to retain a minority interest, or about 40%, with a pretty high royalty rate. I guess the upside to us was, they only talked about it being a couple pennies dilutive to their business. We would have thought it might have been a little bit more than that. So I think that's really good news for them. But again, the deal hasn't closed. It'll close here in I think the second or third quarter of this year. So a little bit longer to go. But again, hopefully we'll get a little bit more details on that transaction sometime tomorrow as well.
Yeah, and do you feel that's the way to go for them, or we have to wait for the details?
Well, look, this was announced months ago that they were gonna do this, and it was rumored for months before that they were going to sell the China business. So it's a done deal. At this point, we're just trying to figure out what the economics and how the economics work going forward, which is still a little hazy in our view.
All right. And any potential headwinds for them going into 2026?
Look, I think the consumer is still stressed, still under pressure. Inflation's still hovering around. If you look across the restaurant space, there isn't a lot of great news recently, especially in 2025. I think you're battling for market share here. So that is definitely a headwind. But look, they've got some levers in place to try and combat those headwinds, and so far they seem to be winning. And their commentary on January suggests their trend continued to be very strong that month as well.
Okay, we'll wrap it up there, Peter. Thanks very much for joining us.
Thank you.
Peter Saleh is managing director and analyst at BTIG.